Today, we're joined by Matt Calhoun, a director at Equity Trust Company, one of the nation's largest self-directed custodians for retirement accounts. Matt has over a decade of experience in the financial services industry and brings a unique blend of expertise in personal finance, real estate investing, and self-directed retirement strategies. He specializes in helping clients diversify their retirement portfolios into alternative assets. And today, he's here to break down what's changing, what investors need to know, and how to take advantage of new opportunities. Thanks for joining us today, Matt.
Yeah, thanks for having me.
So, what's the feeling in the space with the new executive order? What's going on with the changes that you're seeing?
Yeah, it was interesting. In August earlier this year, the administration put an executive order called Democratizing Access to Alts for Retirement. So this was basically an instruction to the Department of Labor, the SEC, to look at better ways to get access to alternative assets, private assets through retirement accounts. Equity Trust has been doing that for 50 years, so this obviously isn't anything new. People have been able to invest into private assets with retirement accounts for a long time. But when it came to private pensions, 401ks, deferred comp plans, there's a lot of red tape involved. And the directive of the order is to basically cut some of the red tape, find ways to make it a little bit more accessible to large group 401k plans and pension plans to get into private assets. So we're pretty early on to see what that actually looks like, but it could have some big ramifications into the space.
So is the executive order actually protecting investors, or is it limiting their freedom?
I would say it's doing the opposite. It's kind of expanding the investment options for sure. Right now, if you have a 401k, you basically get a pick list of what the group that set up your 401k allows you to invest in, and mostly that's going to be a pick list of hedge or mutual funds and different things that are in the public markets. The executive order is looking to give exposure to private assets, cryptocurrency, private equity, real estate, being able to be held in a retirement account. These are assets that were always able to be held in retirement accounts, but when it came to your group employer 401ks and retirement plans, you didn't have access to these asset classes. So it's really looking at ways to expand the investment options to retirement savers.
So how is this affecting financial advisors build their retirement portfolios moving forward?
So to be determined on this one. One of the big sticking points has always been, where did the fiduciary come into play? Like, who's doing the due diligence? Who can recommend it for investors? Because everyone has a little bit different investment horizon. One risk always was, when you have a 401k plan, you may have somebody who just started who's really young in their 20s, who has a longer time horizon, and you have somebody who's a year or two away from retirement. So those groups that had to kind of do the planning for what was available, it made it a little difficult. So one of the red tape that's looking to get cut is, getting rid of the liability of the fiduciaries to recommend alternatives and make sure it's still accessible. So how that'll affect the individual planners, it's hard to say right now. We'll see as kind of more gets rolled out. Some advisors have always been able to kind of allocate towards private assets, but the issue becomes, who are they employed by? If they're employed by groups who only support public equities, then that's kind of what they offered, and they kind of stuck to it. Some of these groups that historically have only looked at public equities are looking at ways to get into the private markets now. I think they're making some aggressive push, whether through acquisitions or opening up their divisions and staffing a little more. There's access, and there's definitely know that their customers are looking for private assets too, and they need to adapt to that. So we are seeing large institutions. I think that will trickle down to the advisors eventually as well. Like I said, some are advisors already doing it, but I think we'll see more advisors get into the private space as well.
I agree. I'm starting to see a lot more funds are, starting to do private debt. Um, and, that kind of brings up a question in my mind, like what people are investing in with their IRA accounts, and what most people think are private investments are risky. And is that still true today?
So what people tend to invest in, like what we see the most in our division, is private equity, private debt investments, and that centers around real estate. But we've seen, like you said, a big increase in private debt this year. Everyone's looking at ways to get into private debt. That kind of trickled down from the institutions, and now the individual investors know that that's a good opportunity. We've always seen a lot of real estate investments, whether development, syndications, funds. But then a lot of people just lend money out to local real estate investors. People invest in cryptocurrencies and gold, silver. We see that a lot as well. And we've seen this kind of oh, okay, that was the one thing like I said, if I'm an advisor, some of my clients might allocate a little bit of money towards. But I think after over and over, their client asking how they can buy Bitcoin in their retirement account, or how can I get involved in this real estate deal, seeing the possibility of outsized returns, then they kind of had to adjust. As far as risk, I mean, it just helps to invest what you know. Obviously, that's kind of what I always say. It's not risky if you know it really well. So people think alternatives are riskier because it's a different asset class. They're not used to it. They don't do quarterly reports all the time. But if you know the asset class or believe in the people who are providing the deal, then it can be less risky than the public markets, who a lot of people just blindly invest in anyways.
Yeah, that's a great point. So, what are some of the biggest mistakes that investors are making when they're adding private investments to their retirement portfolio?
Not knowing the differences between like public markets. Currently, obviously, if you're investing in the public market, I could buy a stock in the morning, I could sell it in the afternoon. There's less liquidity in the private markets. Depending on the investment class you're looking at, it's different. There's not a ticker symbol. We don't get updates and valuations all the time. And some investors don't have the patience. They want to get in alternatives. They don't realize that it's a different time horizon. You may be in an investment for 4 or 5 years to see a return. You're investing in a business, not investing for the earnings at the end of the week. So just setting the expectations a little bit differently is one thing that I would say comes into play with getting into privates for the first time, is kind of knowing what the differences are between investing in public securities and investing in private markets.
I know that this time of year, people are starting to think about doing a Roth conversion, and sometimes it's not for everybody. So, who should not do a Roth conversion? You rarely hear experts talking about that. So,
Yeah, I'll state, not a financial advisor, so a little bit of opinion, but the fundamentals of when a Roth conversion would or make not make sense are pretty simple, in that you wouldn't want to do a Roth conversion if you foresee in retirement your tax bracket being less than it is right now. So I wouldn't want to do the conversion, pay 30% tax, and then in retirement be pulling out money at 15, 20% tax, because I've lost the tax arbitrage. So in most cases, you want to do that if you foresee your tax bracket being higher in retirement. There's still reasons might want to do it, but as far as like an easy rule, that's a good reason to maybe not consider. Also, if you're pretty close to retirement on a conversion, there's a 5-year hold period on those dollars you convert. Some people don't know that is, when you first start a Roth account, there's a 5-year clock on your first contribution, and then you're good, and everything else is tax free. But when you convert new dollars, those dollars have their own 5-year clock. So if you're 2 years from retirement and you think you're going to get tax free withdrawals, you do this big conversion, you don't want to touch those dollars for 5 years in retirement to get the full tax free benefit. So a couple things to consider when doing Roth conversions.
so what's the number one end of year mistake you see people make with their retirement accounts?
They wait until like the day or two before to like try and do all the planning. There's only so much you can do at the end of the year as far as planning. Your income's kind of what it is. We've done everything we can, but one thing is just wait until the very end. We do get people who just kind of wait to do the Roth conversion. It's still doable in most cases, but if you wait too long, you don't want it. It is a hard deadline. If you go into January 1st, now you have a 2026 or the next year conversion. It may have not done you the benefits of 2025. The benefit of the Roth conversion is just knowing you actually know exactly what you made probably in that year too. So there's not like any gray area. Oh, if I end up making more, maybe this conversion was a good idea. You have a pretty good idea of what your end of year income is going to look like. So that is a benefit at the end of the year as well.
So, what's the smartest move someone should make in the last 30 days to reduce their taxes?
So the Roth conversion isn't a benefit really of reducing their taxes now. So if you want to reduce your taxes now, that would actually be contributing to traditional IRAs. If you're eligible for a solo 401k, a great option to kind of get more money into a way to reduce your income, I should say. You can contribute almost 10 times as much to a 401k than you can to an IRA, and that can help reduce your income and maybe pay a little bit less in taxes. The Roth conversion is a way to actually pay a little bit more in taxes now, with the idea of being able to pay less overall tax down the road, converting it now and then having tax-free returns and withdrawals later. So depending on the situation you're in, those are two tools or two levers you could pull on to help reduce either your taxes now or your taxes later.
If someone feels behind on retirement savings, what's the fastest way to catch up, do you think?
So as I mentioned, the solo 401k, as far as getting more money every year into a retirement account, is the way to go. If you do have a 401k through work, you don't run your own business or have no employees, you might not be eligible for a solo 401k. Contributing to that 401k at work and also doing like a Roth IRA on the side is a good way to do it. You have catch-up contributions once you're over the 50 and older, so that helps you get a little bit extra money. And then the idea is basically you want to get an outsized return to catch up at that point as well. You want to make sure you're doing the right things, gaining rates of return to get to a better place in retirement as well.
So, what are you seeing with this new executive order? I guess let's dive more into that
Yeah.
in plain English and detail.
Yeah. As I said, it happened in August. We haven't really gotten word back from the Department of Labor, the SEC, but everyone is kind of positioning and getting in place to what they can do if it does kind of go the way they think it will. We haven't seen a big difference. Like I said, you've been able to hold retirement or privates in retirement accounts since the 70s, and we've been doing that here on an individual level. What will we see if all of a sudden all these 401k plans have privates and then people leave and they need to roll them over to retirement accounts? So we're trying to think about that. So that's definitely one thing to consider. And then some of these groups are figuring out, like, okay, well, how do I get ahead of this and start getting the pieces in place to accept retirement dollars? Depending on your offering, sometimes that's not much that has to be done. Like maybe it's an update in the sub docs or we're changing our marketing material. But for some groups that are maybe seeing a large chance here, a large opportunity, they're putting some big pieces in place for the executive order. So worst case, it's definitely generated a lot of buzz around private assets that already have been happening, but we're seeing a lot more people interested and wondering how they can do it. And then, yeah, I think, I have my opinions on how it'll kind of go out and how it'll shake out maybe, but time will tell a little bit more on what that'll look like.
Well, what's your most controversial opinion about about retirement planning?
I mean, as far as it pertains to the executive order, I think at least first we'll see very large PE firms and the household names that we know. They're going to be the first ones to benefit. They know it. I've listened to. I've been in person with a lot of interviews, and they get big smiles on their face when they know this executive order is coming. It's a big way that they're going to get a lot of money coming in. It's been no really surprise. I guess maybe this will go into like a retirement planning. One thing that's always helped the public markets is every single month people get their paychecks and automatically they buy a bunch of shares of stock. It helps support share prices. It's kind of driven the market up a little bit. It's a large sum of money. So now the private markets have said, hey, we can get some of that too. So every month, all of a sudden, we're getting checks coming in from people buying more shares and these pension plans buying large sums. Is that controversial on the public markets? Yeah, it's kind of been a weird thing that people are just blindly getting more and more buying into the public markets and they didn't know what they're doing. The opportunity now is that the public markets are going to be able to have the same benefit, that they're going to be able to have access through pension plans and large employer 401k plans to get money into the private markets as well.
So besides private credit
Mm-hmm.
that has seen an influx of capital, which has basically been the story after the banks tightened credit conditions, right? So the private credit
Yeah.
stepped in and became the easy place to basically generate yield, right? What are the strategies you're seeing today? Like industrial, open air shopping, I don't know, the good old darlings, multifamily storage in the privates. So what are you seeing kind of getting attention today
Mm-hmm.
in these market conditions? Just kind of today from your perspective. And you guys do quite a bit of transactions. You're the largest alternative custodian. So love to hear that.
Yeah, I always say we don't get like opinions. We just get to see what happens afterwards. So we get to kind of review the game tape kind of after it's happened. Yeah, I think we're in a really good Goldilocks period for private credit, Mike, as you kind of outlined. And on top of that, we saw interest rates kind of go up a little bit. So a lot of private credit going in, and that involved debt funds. And we even had people shift from they used to be offering equity investments, and now they shifted to raising capital through debt funds as well. So we definitely saw that. Cryptocurrency saw a big boom in 2025 and 2024 as well. So we did see that. We didn't really see as many like crypto funds as we saw a few years ago. So there's really more your individual investors were getting into cryptocurrency. On the real estate side, I think you kind of hit on, we don't see quite as much syndications or buying, value add apartment buildings as we saw a few years ago. We're seeing more self-storage. We're seeing some cold storage investments, some DSTs. Like we're seeing real estate centered investments, but it's not like 2019, 2020 when everything was we're buying value add multifamily. We're still seeing it a little bit, but I would say it's definitely down quite a bit from the highs of a few years ago.
Yeah, appreciate that. Just curious if you're seeing kind of renaissance of industrial, because part of Trump administration policy has been made in America, reindustrialization of America. Are you seeing kind of influx of capital? And multifamily, it's no surprise, right? The market's reset. A lot
Yeah.
of people took it on the chin. People have scars. So naturally, people just gravitate away from that. Also, people learn quite a bit that value in multifamily is way harder than it looks, especially on the older assets. So
Yeah.
people got very, the word for it, I don't know what's the right word, disfranchised, I don't know if that's such word, with the older multifamily assets as just kind of, it didn't work out the way people hoped. And interest rate reset the market. But industrial, we've seen this, shopping centers have held up remarkably well. And, Bitcoin and stock markets have done really well, other than they appear to be in a significant balloon and correction. So now may be the time for some other alternatives to shine, because those publicly traded liquid strategies, they've done well in the past, but that's definitely not indicative of future.
Yeah, with industrial, there was always an asset class we didn't used to see very much of. And the reason was they didn't go to the mom and pop retirement account investors. They weren't looking at the retail investors as much. But I think we've seen a big boom in that now, where they've shifted and go, oh, wait, there is an appetite from your retail investors or retirement account investors. So we obviously live in the world where people are writing $50,000, $100,000 checks, but there's not much else. Industrial used to be like, well, you need to come in with $1 million, you need $500,000 to come in and be involved in the deal. Not the case anymore, especially like you said, this year. I think we've seen a big shift where they go, oh, there is this appetite where these investors used to go to value add multifamily, and now they can get involved in industrial. That has kind of boomed a little bit of growth there. I think we'll see more of that next year. Like I said, because we see all the individual investors, we're kind of always, we see it later on after it's gone to the family offices, the RIAs, the sophisticated investors. Then we start seeing it again at the next level, and that's where we start seeing the growth in asset classes. So I think we've seen a little bit, but I think we'll see more here soon.
Yeah, I appreciate that. And then you mentioned something earlier, structural complexity of having a mix of private and publics in a 401k when people want to leave the job and they want to take their account with them. I'm just curious how you're thinking about that whole exercise, because these are illiquid long-term investments and valuations are not trivial in the middle of a life cycle.
Correct. Yeah. What I think that'll play out is I think we're starting to see a little bit more development of secondary markets, where that was kind of not a thing for a long time. I think that will have to be. And then tokenization actually used to be kind of like a haha, like that'll never happen. Or some groups have always kind of like said we're going to do tokenization. I do think that is going to help solve some of the issues. You still can't just create a secondary market from assets that don't really have secondary buyers. But I think just giving more of a marketplace, like people just didn't know where to find private opportunities. I think that will help, because there are going to, to explain what the problem is some of those investors have to have distributions, or they retire and the plan kicks them out. They need to be able to sell those assets, get cash, find it. And before, a lot of times it was, well, I guess go back to the investment provider, see if someone wants to buy your shares, or if you know a friend or family who wants to buy your holdings, like, okay, try that. Groups are coming up now that are creating these secondary marketplaces. And then, one large group who we would all know thinks tokenization could be a piece there as well. Like I said, where that used to be kind of just the buzzword that people use to kind of, I don't know, shade some bad investments. Like they didn't actually have a good investment plan, but they understood tokenization. I think we'll see a more mainstream tokenization of privates, and that could create a better way to sell in the secondary markets, create liquidity, and then kind of solve some of the issues of these plans not having cash to be able to cash out investors, or if they have an aging workforce, having large amounts of those people need to cash out and get funds out of the retirement accounts. I think that'll help solve for the problem, but we'll see. That's just my guess.
I'll add just one question and a comment. I thought quite a bit about tokenization, and tokenization is just a mechanism, right? It's just it's a way to assign a token of some complex contract. You can't really trade securities the same way, because the private investments generally are non-transferable securities. So I think the bigger issue, at least what I've seen, and I just love to hear your thoughts, is marketability of whatever that asset is. The token is a transfer mechanism in theory,
Yeah.
but the asset itself, being a private asset on some deal, whatever it might be, you don't have a lot of buyers and sellers. It's a limited supply demand type of a market. So you either got to go find a buyer which will buy a position in that private investment. And if you can't do that and there's no clear market, that's the complexity of the whole exercise. Even if there was full tokenization and the mechanism to make the transfer, if there's no supply and demand, what are you transferring? You're transferring into who?
Yeah. Yeah, correct. I think that'll be more of the mechanism. I think creating a secondary market helps because right now with privates, I don't think there's a perfect market in that there's just a lack of knowledge on where to find these deals. People don't know. I mean, you get asked all the time, like, who do you work with? Those things. So I think those marketplaces can help. Now, granted, is BlackRock going to have a different demand than if I decide to like put together a small like deal myself? Yeah, 100%. Like they're going to have a better supply demand for those assets than where. So I think, especially as this rolls out, large firms are going to be the ones that see the outsized benefit. And then we'll see what systems can get put in place to hopefully that'll trickle down to smaller privates. That's kind of how I think it'll play out. And sounds like you kind of think similarly.
Yeah, so it's a great commentary that the bigger firms will have an advantage. Simply, they may have more buyers and sellers. They can market the product, and it also enables them to collect kind of commission on every transaction, every time they trade. So these long-term private investments are not designed for frequent trading because of the transactional costs, etc. But yeah, it's a great. I'm going to stop.
Yeah.
Maybe Ryan have some questions.
Yeah, I kind of wanted to actually have a follow up back on that executive order because that got me thinking about a number of things. But it seemed like the main takeaway you were kind of detailing was that was really loosening restriction or regulation in the alternative space. But equally, there's a lot of, folks out there that are saying, we're pretty overheated in, crypto, overheated in equities valuations. Like, I'm wondering if, you guys as a group are kind of looking and thinking through the impacts of that and what your forward guidance is on like who the true winners might be, looking through the rest of this year and into next.
So unfortunately, as the admin, we kind of just direct on what our clients want to do. So we don't actually get to pick or tell people in any direction. I guess the benefit or the negative of not being the fiduciary in that case. So the markets kind of get to play that out with those larger pensions, like going to kind of pick the basket that people can choose from. Like, okay, well, when I allocate my 401k, do I want to invest 10% in crypto, 10% in a real estate fund or private debt fund? So I think that's where that'll come into place. But yeah, as the admin, we just kind of have to go by the direction of the investor and how they want to go into
No, that
things.
makes sense. But
Yeah.
I guess the broader industry sentiment, though, with your side of the fence, is that this could theoretically open up a broader influx of investment, though, because of having that, those regulations dropped and opened up, new investment opportunities, essentially.
Yeah. I think this is going to be access to people who just didn't know private assets even really existed or didn't know they could do with the retirement funds. Like, even though self-directed retirement accounts and 401ks are a lot more popular now than when I started doing this, most people know about it or have something. Every day I still hear people are like, I didn't even know that was a thing. They're going to get hit with that again when they realize, oh, I can, when I'm picking out where I want to allocate my 401k, I can get into this private fund as well. So yeah, that'll definitely spur a lot more interest in private markets, more than we've already seen. I mean, the trend has been more retail investors getting into private markets. This will grow that substantially. Whether they, know or not what they're getting into, different story, but it's going to definitely expose people to private markets that weren't in it before.
I'm actually curious too, beyond that, if you're seeing, increased express interest in that or in a broader array on the back end, are you guys looking at how you kind of even present your own capabilities or systems to present that to the individual client on your own side, like logistically? Or
yeah, I mean we've had the systems in place for the individuals to do it, so we probably we won't be administering large pension plans or anything like that. We still like the individuals, but those individuals are going to have to move funds out, move assets out of those employer plans eventually. So we could definitely see an increase demand in our services just based on that. People want to keep those assets. Like I said, I don't think we'll get into the group plans, the large employer plans. There are groups who are doing that, and now they just got to figure out ways to grow their systems to accommodate for private assets too. But yeah, I think we'll see an increase in individuals that are holding privates, have been holding stock in their 401k for a long time. And now they got to find a place to park it outside of those employer plans.
Is Equity Trust Company using AI?
We are. So we use it mostly on the sales and marketing side quite a bit. I always I talk to a lot of people that are in AI that I don't think enough's been done or tested on the compliance and review side of things yet. So we'll probably wait for somebody else to test those waters. But right now on the sales and marketing side, we use AI every day, quite often. But yeah, until we basically have some case law or some people tread that water on the compliance and review of investment documents and everything else, I think we'll be cautious on letting AI do that. But it's going to happen in the future. It's just a matter of what group feels confident enough to let it do due diligence and compliance pieces.
Are you seeing a lot of people using like AI financial advising platforms?
Yeah, definitely. I mean, we don't plug in. I don't know if we have any like API integrations or integrations with those groups, but yeah, I mean, I think it's just becoming more common. People are going to their AI tool to figure out things and pulling things. Yeah, I think, and it's here to stay. I think it'll be something people will use a lot more. I think we'll see certain generations not want to have the AI advisor, but we'll probably see younger generations that's all they're going to do. They don't want to talk to a person. They're just going to want to type in financial questions to an AI, and try to get the best answers that way.
No, I'm a young person, I like to think. And I would much rather talk to a person than AI. I think maybe because I use it all day, every day, I know that it's only capable of so much. And it likes to tell me yes to everything and say all the nicest things. So I don't know that's what I really want out of a financial advisor is I want somebody to tell me, no, there's a boundary or, you know, don't
It
do
won't it won't be long until your financial advisor is just getting the info from the AI anyways. It wasn't long ago. So when I first started financial advising a long time ago, Department of Labor came out and looked like they were going to put some pretty hard restrictions on advisors, and most of the companies kind of overcorrected in anticipation of the Department of Labor ruling. Basically, yeah, most of your financial advice was just spit out by a computer. You just put it in and say, okay, what's the computer saying? Like, okay, well, I think that this is what the computer said, so you're going to do it. So I think most in the financial services will probably be AI prompted, and maybe you'll have that person at least run through and maybe have some controls in place, but I'm sure a lot of it will be AI dominated in the future.
depends on how much money you have.
Yeah.
So but yeah, I mean, I keep seeing these things are where people are going to be going towards. And I'm like, where are these apps? I guess I don't even know about them. And I've been asking financial advice from ChatGPT for, over a year now. And it's recently the news is telling us that they're not going to do legal advice or financial advice anymore. So I didn't know they could ever do that. I tried to trick mine into doing it and it never would. And so I'd be curious to learn about whatever apps these people are using about, for doing big investments and trusting it because there's a lot of work still needed on AI to make it really trustworthy.
But can I chime in on this? So my experience has been you can ask your AI tools best practices, and it can actually give you some. Like I ask a very simple question: what portion of one's portfolio should be in real estate relative to the entire portfolio? There's no right. It's just a very high level generic question, and it came out between 25 and 40%. And depending how you phrase it, some other some other tools could be lower, higher. All depends about your primary residence. So I think generic high level, I don't call it advice, but best practices is probably the most common use, while the investment advice is the danger zone, and nobody wants to be liable if they tell you, hey, you should have more in this, and then this is somehow thought to be an advice. So I think advice, it's a high liability, high risk type of a thing, and you're paying $20 a month to ChatGPT. I don't think they want to be liable for you writing, $100,000 check or $1 million check and then losing that money. So that whole area is probably going to be a long time. There needs to be a formally licensed advisor, but you can be pretty sure soon enough these advisors going to get a lot of thoughts from these tools, and then compliance departments. And the bigger the advisor, the more they're going to look to protect their back. And then small or regional, RIAs maybe will open the door to a little bit more alternatives. It's kind of interesting. It's either really big players with the ultra high net worth folks, the Goldman Sachses of the world, and access to privates is just kind of very sought after. And then you got all the way to democratization of these investments, kind of what you do, but you don't give advice. And I don't think too many RIAs want to play in the space of these deals, especially in light of some of the recent volatility in the space, right? So it's kind of an area where I think there's a lot of opportunity, at least it feels that way, but it's a danger zone. People don't want to. If you buy Google stock or you buy any other, you buy Microsoft stock or other AI company or the Mac 7, and they go down, well, everybody was saying these are great companies, right? So it's from their own liability protection. It's an area of you go with the crowd or you take the risk that if things don't go well, what's your upside versus your downside?
I tried to trick mine. Just a funny story. I tried to tell it what its role was and who it was and what kind of. I was like, if you were this person, what would you invest in right now? And it tells you straightforward. It's not going to answer your question. It's like it's not that stupid. But then I don't know how these people are getting all these answers. I'm not able to get. So anyway, I do use it for marketing things and helping me write sometimes. It's been really good for that. And it helps me with educational content a lot. But what I've learned is you always have to have the human touch. So I think where people should be careful is if you are looking up the best practices, but definitely consult with your financial advisor or CPA or a lawyer to see that you're making the right decisions, not just based off of what AI is telling you.
I have another question. I'm going to chime in. This kind of, I've seen this, people ask this question. I think, Matt, would love to hear your great expertise here. So it's end of the year question type of. So many custodians ask for valuations, and it's a standard routine. And plenty of people have investments in funds and deals that have distress or challenges or issues. And some folks are at a point where they have to take required minimum distributions. So it's important to get these valuations. But the most difficult part, people can reach out to a private sponsor and say, hey, what's my investment was worth? But the difficulty of valuation is incredible today. So I don't know how are you dealing with this today? Because you can ask the questions all day long. And the struggles are, I don't know what it's worth if there are some market conditions challenges. I'm just curious, how are you handling these type of conditions for valuation purposes, for required minimum distributions, et cetera?
Yeah. I always say for most investors, as long as it's just a market value, but for the RMD investors, it does matter because it affects their taxes now. The valuation that they have now, basically determines how much money I have to pull out this year. But yeah, it's tough. I mean, we always say it's not an exact science, especially with private assets. Most sponsors, if the investor puts in 100,000, it's $100,000 investment for 4 years of a 5-year investment. Like then that 5th year, we're like, oh, okay, here we know exactly what it's worth. That's pretty common.
But what if the investment
mentioned,
is not going well? Just an example, They put some money into multifamily and that asset class is distressed. It's worth somewhat less, if not a lot less. That's the complexity, just as an example.
Yeah. I mean, we don't dig into them too much on there, but we would like to see a fairly accurate, judge of market value at that time. And for that investor, it actually is beneficial to them to have that lower one. The issue I've always seen is there's kind of competing, like for your investor who has an RMD or wants to do a Roth conversion, they like that valuation be a little bit lower at the end of the year, as long as the deal horizon is going to be good, long term. They kind of like that idea. But your investors who are not doing RMDs or are not doing Roth conversions want to see a pretty good valuation. So there's kind of conflicting stuff there. I mean, we like to think that there's the most accurate. But yeah, we do valuations for 50,000 different groups. We're not digging into them too much. But yeah, ideally factoring in all those things would give you the correct valuation. Factoring in tough markets, illiquidity, different things would arrive with the correct valuation. like I said, for most investors, it doesn't change anything. It's just a different number we'll put on the statement. But for the RMD investor or investor who has taken RMD, it does make a difference on what they'll have to pull out at the end of the year.
I'd be really curious to know how many people are actually doing a Roth conversion this year
Yeah.
versus last year.
Yeah. We'll see. I don't, obviously we'll see it at the end of this month, kind of what that looks like. Um, every year, some people do it, so I'm sure those people who do it every single year will be the same, but I could see if valuations are down a little bit for whatever reason, we might see more Roth conversions for sure.
Is there like a checklist for someone who is looking to do a Roth conversion, so that they can think about it for either this year or next year?
Chat GPT it. So I don't have a checklist at all, but yeah, a good thing to consider. Like I said, the first thing is always long term. Do I think my taxes will be up or not? So that would be kind of the thing to look at. If I have cash, it's a really easy conversion. So if you have cash already in an account, I want to convert that amount of cash to my Roth. That's really easy. It's done. But you can convert existing assets too. So if I'm invested into a multifamily deal and I want to move that deal into my Roth account, that can be done as well. It takes a little bit longer. So that's one thing I would say is if you have existing deals that you want to move over, that involves sometimes a new documentation being done. So it takes a little bit longer. But yeah, it's really as simple as just talking to your custodian. Okay, what form do I need to fill out? If it's cash, that's really all it is. It's just I have a Roth account. I fill out a form. We move money from traditional IRA to Roth IRA at that point. So it is a pretty simple process. If it's an existing asset, a little bit longer because there's normally some kind of other documentation to show a change of ownership from traditional IRA to Roth. This time of year is really nice because you can get the valuation of an existing asset to know what we need to convert. And you can convert some in 2025 and some in 2026, split up that tax bill over 2 years and convert a larger sum and not have to bother anyone about fair market value reporting or valuations twice. You can actually just bother them one time and do 2 conversions and kind of get that out of the way too. So that's always a strategy I do like, especially if you kind of know what you're going to make and you're trying to max out your tax bracket. You can max out this year. And if you think next year is going to be very similar, you can max it out for next year as well.
It's a really great idea, actually. I haven't seen many people do it that way. But yeah, I definitely see that being a benefit, especially if we're looking at potentially next year being not a really big gain year. We'll see. There's a lot of conflicting news out there right now, and it's a bit confusing to know which source to go to for accurate information. What are some of your favorite sources for this information, Matt?
So I follow a lot of newsletters. I do like newsletters, so they kind of compile a lot of different sources. So CRE Daily we look at a lot. Just different newsletters that kind of pull a lot of different information. You kind of start to see a picture painted. Now, if you subscribe to a bunch of them, that's what we do even as a team. We try to subscribe to a lot of different newsletters because you might have one who's trying to like paint a certain picture of an industry. But if you start compiling those, I do like that idea versus just going to like one particular source. I think it's a good way to consume a lot of information at one time. Even if you're just looking at headlines, you can kind of start to see, okay, well, if that same headline's repeating itself across 5 newsletters, there's something to that. So that's kind of what I like to do. And we're just involved in so many asset classes, so I try to keep up with all of them, and it's hard to like dig like deep into everything. So that's kind of our way to digest a lot of info at once.
Go to a lot of events too. So
Yeah.
what are you seeing this year compared to last year?
So depending on the asset class, attendance can be down a bit. Real estate, I think people aren't quite there with enthusiasm, which might mean it's the time to get in. When things aren't done, going well, maybe that's the time to start investing. But I do think attendance is down a little bit across real estate investments. I do like attending some of the, like I said, we kind of serve a retail investor, individual investor. I do like attending the groups who are institutional level investors because I think that gives a good idea of what's down the pipeline for the individual investors. The institutions tend to set the trends and figure out what's good first. And then within 6 to 12 months, we start seeing that trickle down into the individual investors and the advisor channels and everything else. So I attend those events as well. But yeah, attendance is kind of down. People are still enthusiastic looking for deals, but I think it's not quite, they kind of know what the realization of the landscape is at this moment.
I think it's because they're using ChatGPT more to find investment opportunities.
Definitely possible. I kind of have a theory that post-COVID, people were just really excited to get out to live events. So we started to see a big like boom in live events and people just wanted to be out and talking to people in person or anything else. And now that's kind of waned a little bit. We're 5 years later and like, okay, well, I can just attend it virtually or I'll catch a video later or ask somebody else how it went. So that could be part of it too. But we'll see. I'm intrigued to see what the rest of the year looks like. We do attend, like I said, a lot of real estate note groups, private equity groups as well. So, you know, but the trend has kind of been a little bit of less people attending the larger events. But I do think regional events are doing really well. I think people are maybe just more willing to travel in their regions versus going to across the country to attend a live event.
Yeah, definitely.
Quick question on precious metals. Again, just curious. Gold has done remarkably well. Silver has done too. Just how has this year been seen significant inflow of capital in precious metals? Are people taking some chips off the table now? You obviously see market correction, crypto correction. I mean, as we're recording this, gold is holding up. Maybe that's the real, true, only hedge against volatility and uncertainty. I think gold it's not really been ever a hedge against inflation. Although people call it a hedge against inflation, it's been a hedge against volatility and uncertainty and market instability and world instability. But what are you seeing now? I'm just curious. It's done so remarkably well. It's probably beat most of other asset classes and kind of just curious what's happening.
Valuations have done really well. The actual like investor growth year over year is actually kind of flat. And that kind of makes sense. If we're at all-time highs, we can see where people aren't rushing in, which is good. Maybe they're not rushing in to go buy at all-time highs. But valuations are definitely up there. Like I said, we're still flat, basically like 1 or 2% growth over last year as far as precious metals investors. I don't think people are rushing out to sell, surprisingly. I figured, okay, this is good. I could make a good profit. I don't think people are rushing out to sell just yet. And that could just be they don't know where else to go. Like, yes, gold's done really well and they like the number. But if they sell, they have to put it to use somewhere, and maybe they just don't know where to go next. That's my explanation for it. But yeah, as far as new investors, a little bit of growth, almost flat year over year. But obviously, the dollars that are in those accounts are doing really well.
Are there asset classes in particular that you guys are seeing held within your investor pool that are really increasing or decreasing, that are showing real changes in this current market?
So we won't know until, as Mike kind of alluded to, with fair market values, we normally see those trickle in January and February. So that's when we'll see very few investments update us quarterly. So we really haven't got updated valuations for most investments until winter of last year. So we'll start seeing the increase going next year. The ones we do see more frequent are hedge funds, crypto funds, like cryptocurrency, and then like trading accounts. Those will obviously increase. It's been a good year for the public markets. Most hedge fund strategies have kind of just put it into the public market and collected their fee. And then crypto did really well up until the last few weeks. We were hitting all-time highs. So obviously those valuations are really high, but it'll be interesting to see January, February where the rest of the private assets are valuation year over year. But we'll see that info here soon.
Yeah, we should schedule a follow-up then. I've also heard obviously a lot of people will review allocations right into that new year after the quarter closes and the year closes. So could be more changes up front too on that as well. So,
well, Matt, I know that we have been here for an hour now, and I really appreciate your time. Thank you so much for coming on again. It's been a good conversation as always, and I would like to schedule that follow-up call. Definitely want to hear more about what you see in the next few months. I know that in the new year, I'm hoping for a pickup of interest in real estate, just because of the opportunities that we're seeing out there. And yeah, we definitely want to see you at an event soon.
That was great. Thanks for having me again. Appreciate it.
Thanks, everybody.
Thank you.
thanks.